Hello, I'm Thomas Groenen, Global Structuring Financial Services Leader, and I'm joined by my fellow partner, Giovanna Tanusis. Today, we're going to talk about the impact of the Big, Beautiful Bill Act on global structuring, what made its way in, what did not, and perhaps what to keep an eye on.
Thanks, Thomas. Perhaps to kick off, how would you rate the international provisions overall and their impact on our financial service clients?
Overall, the removal of proposed Section 899, no change to carried interest, and some of the business tax provisions, I think, in totality, have to be seen as favourable.
And perhaps touching on proposed Section 899 and whether do we think it's gone for good?
Good question. So just as a reminder, the proposed Section 899 was meant to address countries with unfair foreign taxes, such as the UTPR and potentially digital services taxes and diverted profits taxes, by imposing additional tax on US source income paid to their residents. This was removed from the bill at the request of Treasury Secretary Besant. This was following a June 26 announcement by the Secretary that other G7 countries had agreed to the US position that certain aspects of the Pillar 2 regime should not apply to US multinational corporations and their subsidiaries. However, it is important to note that this is still on the understanding that the agreement will be further discussed with the non-G7 members. It was also made clear by the statement released by House Ways and Means Committee Chairman and Senate Finance Committee Chairman that they are ready to take immediate action if what was discussed is then not implemented.
And I think that's an important part. What could these forms of such action be, or what form could they take?
I guess the reconciliation process can be used. Also important to remember that Code Section 891 does remain in the code. This was introduced many years ago, and it provides that the president can double the tax rates on certain US source income received by country citizens and corporations if the Treasury Secretary determines that a foreign country is imposing discriminatory or extraterritorial taxes on US citizens or corporations.
And I think perhaps if we shift focuses a bit to GILTI and FDII, while there were changes to the effective rates under both GILTI and FDII, it seems the most notable change is the elimination of QBI in computing GILTI and the QBI equivalent in computing FDII. Perhaps we touch a bit on the effect of this for our clients.
Sure. The elimination of QBI could result in increased FDII benefits, in particular for companies in capital-intensive industries such as manufacturing, energy, LNG, which previously may not have practically benefited from material FDII benefits due to QBI. This, coupled with favorable business tax provisions, such as interest deductibility generally moving back to 30% of EBITDA, current expensing of certain capital property and manufacturing investments could have material benefits to US-based portfolio companies that produce and manufacture in the United States, but that sell goods and products to foreign customers. FDII eligible income should effectively be subject to a reduced 14% effective US federal corporate income tax rate. On the other hand, the elimination of QBI could result in greater GILTI inclusions, though there were also favorable changes to interest and other expense allocation provisions that could help alleviate that expected increase I mentioned. So overall, I think clients should model the impact of these changes and the broader impact to US-based businesses alongside other favorable changes to the business tax provisions.
Agree, modeling seems to be key here. Speaking of those other business tax provisions to keep in mind, let's discuss the change from EBIT to EBITDA that you mentioned, that you had just mentioned, and perhaps that how that could interplay with BEAT and CAMT.
Sure. On its face, the change to EBITDA is expected to benefit certain structures that are subject to 163J through enhanced interest deductibility. However, clients that are also subject to BEAT and or CAMT should consider the interplay of these provisions and these changes to 163J. While the changes are expected to increase the amount of deductible interest and therefore reducing regular tax, this could increase an applicable taxpayer's BEAT and or CAMT liability.
Let's perhaps shift to any surprises in the bill that could impact our financial service clients. The general restoration of 958B4, for example, was not in the House bill.
Correct. Yes, this was somewhat of a surprise. The general restoration of Section 958B4 was not in the House bill. The expectation is for it to generally be taxpayer friendly. We expect it to result in fewer foreign corporations being CFCs and have favorable impacts on other provisions. For example, on portfolio interest and payment of interest to entities that would otherwise have been considered CFCs. Also on PFIC testing, which provides for testing to be at adjusted basis rather than fair market value of assets in the case of considered CFCs. However, it is important to note that the bill does introduce a new section 951B, big B, which is meant to allow for downward attribution from foreign persons in certain cases. The impacts of this new provision would need to be determined on a case-by-case basis. However, any substantive impact does require a direct or indirect shareholder of a CFC that, taken into account any interest it is deemed to constructively own therein, equals at least 50%. Fund managers should also consider the impact of the repeal of downward attribution and new section 951B, in particular assessing the extent of foreign entities that would no longer be considered CFCs, the impact of this in case relevant for PI, portfolio interest, and PFIC testing, but also the impact from a reporting and filing perspective.
Yeah, that was interesting to see in the final bill. I think also from a CFC perspective, we saw modifications to the pro rata share rules. Let's discuss impact of this in our space, and perhaps in particular on current transactions involving sale of CFCs.
Yeah, sure. So the bill provides that if a foreign corporation is a CFC at any time during a tax year of the foreign corporation, each US shareholder that owns stock in that corporation during the CFC year is required to include in gross income each shareholder's pro rata share of the corporation's sub F income for the CFC year. This is in contrast to the previous rule, which provided pickup to the shareholder at the end of the CFC's tax year. This could have considerable impacts in years where CFC stock is sold, particularly where the CFC stock would not end, tax year would not end as a result of such sale. In this case, the seller may need to recognise its pro rata share of GILTI sub F, even if it would not own such CFC stock at the end of the year. For live deals, it would be important to consider this change, in particular where the CFC tax year would not otherwise end at the time of sale, such as if a 338G election was made. It's also important to note that we await guidance on the determination of what constitutes each shareholder's pro rata share. In the meantime, there are various approaches here that could be considered, and I think it would be key to ensure appropriate language be included and protections sought in any SPAs in relation to live transactions.
I think we covered a lot of the main items impacting our clients in this space. Do you have any closing thoughts you had on the One Big Beautiful Bill?
Sure. I guess overall, we are still digesting the impact, particularly for certain provisions where we expect clarifications through regulations. We're also monitoring developments around unfair taxes as the G7 discuss with the non-G7 members of the OECD's inclusive framework. But overall, stay tuned. There are certainly or undoubtedly more fun things on the horizon.